Welcome to the Luxury Market Report brought to you by MansionArizona.com. I'm your luxury real estate professional, Jeremy Poehls, and in this episode, we're going to take a look at the luxury real estate market in Scottsdale, Arizona. The Scottsdale single-family luxury market is a seller's market with a 56% sales ratio. Homes sold for a median of 100% of the list price in May of 2022. The luxury benchmark price remains at $1.1 million. The total inventory was 480. Total sales, 269. The price band with the most sales was $1.5 to $1.7 million with 33 homes sold. The price band with the most inventory was the $4.5 million plus with 67 homes available. The median sales price was $1.64 million, up from $1.58 million last year, a 4% increase. Total inventory is up 66% compared to last year. Total sales were down 1%. Days on market were 26 days compared to 27 last May. Though it is still a seller's market, things are beginning to look a little more normal with some older patterns starting to reappear. And now for some insights on the global luxury market from our partners at the Institute for Luxury Home Marketing. Luxury property inventory levels increase. What is the significance? May saw a comparatively significant upward shift in the number of homes listed for sale, especially compared to the same period in 2021. This was not unexpected, as there has been a gradual increase of new listings and a slower escalation of price increases over the last few months. According to our analysis of North America's top 140 luxury markets, the new listings entering the market in May of 2022 increased by 61.3%, resulting in the single-family home inventory level rising by 27.5% compared to May 2021. In the attached property market, the numbers were less dramatic but still significant, with 37.3% of new listings entering the market, increasing the inventory level by 1.5% in May 2022 compared to 2021. Overall, the median price for properties in the top 10% of the market rose approximately 16% year over year. Although this is still a substantial percentage increase, it's smaller than May of 2021, which reported a 24% increase over May of 2020. Despite the rising inventory levels, the market remains extraordinarily strong. The sold price to list price percentage rose by 1% in May of 2022. Above an already unprecedented 100% ratio in May of 2021, and days on market for sold properties fell by 30%. Of the 140 markets researched, 129 remain a seller's market. Not surprisingly, the markets that are either balanced or become buyer's markets are seasonal markets such as ski resorts and winter sunshine destinations, whose main buying season has finished. The lead up. There's often a narrow window of opportunity for those sellers looking to sell at the top of the market. After all, who doesn't want to maximize the return on their investment? Judging when the market will peak and leveraging a seller's market is not an easy task, even for some of the most seasoned professionals. The current market has offered many homeowners the opportunity to sell far above pre-COVID expectations. However, it has also come with its own challenges. In the first 4 months of 2022, many homeowners were hesitant to put their property on the market, fearing that they would not find a new property because of the lack of inventory or that prices would continue to escalate and they would find themselves priced out. But as prices began to level out over the last 2 months, sellers started feeling more comfortable putting their homes on the market. And the level of inventory in many luxury locations throughout North America increased significantly in May. Bubble or cooling? This sudden upward shift of inventory has already started the rumor that the housing market is ready to burst its bubble. And indeed, some highly inflated markets and overpriced properties may well be impacted. But most experts acknowledge that this is simply the market finally starting to cool. No one could expect the luxury housing market would continue to accelerate at the velocity seen over the last 2 years. The epic run had to end one day. Economic uncertainty, rising interest rates, volatile stocks, supply issues, and increased cost of living are all aspects that even for the ultra-wealthy could start to impact property purchase decisions. A recent report released by Redfin states that sales of luxury U.S. homes in the top 5% of the market fell 17.8% year over year during the 3 months ending April 30th. the largest drop since the onset of the coronavirus pandemic, sending shockwaves through the housing market. As home prices increased, it is true that the number of people qualified to purchase a luxury property has declined. However, it must be noted that during the first 4 months of 2022, the lack of preferred property types available for sale was the main reason for the restricted number of sales. Now that the inventory crunch has started to ease, this does provide an opportunity for buyers, especially as more inventory is anticipated to help tame the pace of price growth. May's statistics confirm that homes in the very high end of the luxury market are seeing the most significant impact, with reports of less interest from wealthy buyers compared to last year and homes remaining on the market for longer periods. In contrast, there are still many price points and locations seeing high demand, especially if the supply of properties has not increased substantially. Inventory level reality. It is important to put everything into context, as it will still take a lot more inventory to see a truly meaningful impact on the rate of price increases, especially in the low to mid-price luxury ranges. Homes are still selling quickly, spending 4 days less on market than this time last year. Moreover, even with the current increases in supply, inventory remains nearly 50% below its pre-COVID levels, keeping competition tight for now. Nevertheless, a slow but steady increase in inventory could signal the start of market trends that will finally work in buyers' favor. With more options, home shoppers may see a bit more negotiating room and time to make decisions, even as market conditions continue to favor sellers. While buyers are the beneficiaries of this increased inventory, most experts do not predict a major housing price correction or bubble burst for multiple reasons. The U.S. housing crash of 2008 is still fresh in individuals' minds, so it's important to understand that there have been significant changes in lending money. Regulations and systems that provide warning signals and offer tools have been implemented to help thwart a similar crisis. Unlike the lending of money, a major factor in the last real estate crisis, excessive borrowing is not one of the factors fueling the current housing boom. Individuals who are purchasing have the financial means, often buying for cash, or have leveraged long-term low interest rates. The supply of homes is severely out of balance across all price points compared to the demand. The sudden increase in demand for homes and the types of properties fueled by the pandemic situation in 2020 was not anticipated by the building industry, leaving a significant shortage of new homes entering the market. It is reported that there is nearly a 10-year imbalance and that it will take several years for significant construction to add enough new supply of homes to balance demand. Construction has continued to increase, but still not enough to see an immediate impact, contributing to the unlikelihood of prices falling. Add in the last but important demographic of new buyers, millennials both above and below 30, followed by Gen Zers, and their demand for larger, spacious properties, the upward pressure on prices will continue. Although this chart is for the total real estate market, it highlights the significance of these two new groups and their impact on the demand for real estate. First-time homeowners represented at least 30% of people purchasing homes, according to data by both National Association of Realtors and the Canadian Real Estate Association, with most being under 40 years old. In a few years, Gen Z will be turning 30 and more financially ready to become homeowners than millennials were at their age. This means that the demand for homes will be as high, if not higher, while inventory will still be behind the demand. Warning signs and new challenges. The future is not all rosy. Some warning signs point to more negative impacts on the real estate market, including continued rising inflation and ongoing geopolitical issues that affect supply chains. As stated earlier, purchasing a property in today's market will face new challenges compared to last year. But there is a silver lining. If inventory continues to increase, buyers will not only have more choice, but they will also face fewer multiple offer situations and be less likely to have to pay substantially above the appraised value, and will not need to waive all of the contingencies to secure a property. The art of selling and buying in this market needs a critical and analytical approach. Understanding the realities and setting expectations accordingly will ensure that your goals are achieved. For homeowners looking to buy or sell in today's market, I'll capitalize on current trends, your preference, and demands in this dynamic and evolving environment. Give me a call today for a free consultation. Thanks for watching this month's Luxury Market Report. We'll see you next time.